Today, we are going to closely examine a massive, unexpected divergence in what should be identical financial forces. This chart sets our baseline control. We have two identical 10 lakh rupee investments placed into the exact same underlying equity fund. Over a 20-year horizon, both portfolios experience an identical 12% gross market return. Yet, at the end of 20 years, the returns diverge severely. Line A, representing a direct plan, reaches 86.8 lakh rupees. Line B, representing a regular plan, lags significantly behind, capping out at 75.6 lakh rupees. The variance between these two supposedly identical investments is exactly negative 11.2 lakh rupees. This outcome entirely defies standard market logic. Neither investor took on additional risk. Both held the exact same assets, managed by the exact same managers, reacting to identical market conditions. Catastrophic wealth destruction of this magnitude is rarely the result of poor market performance. It is executed by invisible structural mechanics operating quietly in the background of the financial system. The sole variable responsible for this anomaly is the total expense ratio, or TER. This is the annual fee charged by an asset management company to cover the operational costs of running a mutual fund. These two progress bars contrast the baseline operational costs. Direct plans run highly efficiently, typically carrying a TER of 0.70%. Regular plans operate at a higher threshold, typically around 1.50%. The absolute difference between these two operational tiers is a fractional margin of just 0.80%. The central question of our analysis is this: how does a fraction of a single percent mutate into an 11.2 lakh rupee deficit on a standard 10 lakh portfolio? In the world of institutional finance, microscopic percentages are routinely utilized as deliberate camouflage for massive structural wealth extraction. This side-by-side node diagram details the architectural difference between the two platforms. On the left, we see the straightforward mechanics of a DIY direct plan. Capital routes directly from the investor to the fund management. The entirety of that 0.70% expense ratio is consumed purely by the base operational costs. There are no intermediaries. On the right, the regular plan activates, revealing a more complex routing system. The capital flows toward the fund, but suddenly bifurcates. That excess 0.80% TER acts as a continuous siphon. It pulls capital away from your investment to fund an intermediary channel known as a trail commission. A trail commission is a recurring, permanent fee paid by the asset management company to a distributor or platform for as long as your money remains captive in that mutual fund. Unlike a standard upfront commission that you pay once at the door, a trail commission is continuous and percentage-based. It scales up relentlessly, continually extracting higher absolute fees as your total portfolio grows in value over time. We see this structure frequently in the modern fintech landscape. Platforms often automatically convert free DIY users into this embedded commission structure the moment those users opt in to premium advisory tiers. The platforms do not directly invoice you for this advisory service. Instead, the mutual fund house acts as a proxy. They extract the platform's commission directly out of your invested capital. You are perpetually paying for a service that you likely believed was complimentary or merely a one-time software upgrade. The free or premium facade of modern financial platforms is mathematically underwritten by these structural, embedded commissions, completely designed to monetize long-term investor loyalty. We need to correct a common misconception regarding upfront fees. When you deposit capital, 100% of your initial deposit is legitimately used to purchase fund units. The fee extraction does not happen at the deposit door. It operates as a constant, invisible tax against your total accumulated market value. This equation shows exactly how asset management companies calculate their daily cut. They take the annual total expense ratio and divide it by 365 days. If we run a micro example using a standard 1 lakh rupee portfolio operating under a 1% TER, the daily deduction rate equals roughly 0.00274%. Every single day, a microscopic slice of your portfolio is extracted. For a 1 lakh balance, that is exactly 2 rupees and 74 paise, shaved cleanly off the top. This extraction occurs completely behind the scenes, far removed from the transaction logs and monthly statements you monitor. As the market rallies, the target size for the asset management company's extraction automatically expands. When the portfolio inflates to 1,10,000, the daily extraction proportionally recalculates, increasing immediately to roughly 3 rupees and 1 peso per day. This extraction is indiscriminate. The fund house takes its cut regardless of your profitability, continuing to drain capital even if your portfolio is bleeding out in a bear market. The expense ratio acts as an inescapable daily tax on mere participation in the market. This raises a logical question. If the stock market closes on Saturday and Sunday, does the TER extraction pause? It certainly does not. The structural extraction is relentless, moving constantly even when market activity has completely stopped. This 7-day calendar maps out the standard trading week to track exactly when the net asset value, the official price of your fund, is updated and published. Monday through Friday, we see the normal operational rhythm. Deductions and NAV updates happen simultaneously, with the fund price adjusting downward daily to account for the micro extraction. On the weekends, the market goes dark and no NAV is published, yet the structural fees continue to accumulate silently in the background, compounding over those dead days. When the market reopens, the hidden weekend extractions are suddenly and forcefully realized. Monday's newly published NAV always quietly absorbs 3 full days of structural fees at once. The psychological design of your investment tracking dashboard relies on this exact mechanism. The portfolio returns you see are always already net of these complex extractions. Because the extraction is baked into the asset price itself, you never receive a direct bill, ensuring your cost sensitivity is never triggered. The mutual fund industry has engineered a highly effective extraction mechanism where the investor remains entirely blind to the friction acting on their wealth. We can now transition from the microscopic deity view back to our original 20-year timeline to measure the cumulative damage. The expanding gap between the higher direct line and the lower regular line measures the volume of uncompounded capital. Every extracted rupee ceases to compound. The core law of compounding friction dictates that every single microscopic rupee extracted daily permanently loses its ability to generate future geometric returns. This is precisely how a trivial 0.80% fee variance snowballs over 20 years into a catastrophic 11.2 lakh rupee deficit on a baseline 10 lakh corpus. Modern investors rely heavily on sleek platform advisory ecosystems that route their capital precisely into these embedded architectures. You must force a rigorous mathematical evaluation. Is the convenience or automated advice provided by a premium Fintech tier genuinely worth sacrificing hundreds of thousands of rupees in terminal wealth? Ignoring structural platform shifts guarantees that you are severely capping your own ultimate compounding power. By ignoring these subtle structural shifts, you are essentially letting the very foundation of your portfolio dissolve away in tiny daily fractions. Terminal wealth is destroyed by silent, microscopic daily extractions, operating in the system's blind spots, far outweighing the impact of upfront fees.